analysts at Nomura now say that a mild recession in the fourth quarter is more likely than not. Joining us now to talk about the market implications of all this, Liz Young, head of investment strategy at SoFi. In the Journal, the piece mentions total number of economists that they poll at 44%, which they note is usually a number that you don't hit until you're either on the cusp of an imminent recession or already in a recession. What do you think?
That's right. I mean, recession risk has certainly risen. I can confidently say we're in a slowdown. At this point, it's the definition of recession that we're all looking for, and that's a lot of the reason why I think that this volatility can last through the end of July, because that's when we'll get that Q2 recession number, or I'm sorry, that Q2 GDP number, and find out whether or not we actually are in a recession, and then the market reacts to that. I think in this next week or so, as Mike just pointed out, we have some rebalancing tailwinds. We have that end of second quarter tailwind that we might see a pop in the market, especially after such a tough week last week. But I don't think that lasts, and it doesn't change anything about the fact that we're still in an economic slowdown. We're still waiting for some of this economic data to catch up to what we've seen in the market. And I think we still have earnings revisions coming on the downside for the next few weeks.
Right. Mike Wilson was on from Morgan Stanley and said the multiple is already way down, much more reasonable, but now we got to worry about the E. And there's going to be revisions. And his view is if we see a recession or a slowdown combined with profit margins being hurt by inflation, that we're not cheap, that the multiples are not down enough. He said we could see 3,000 on the S&P if we do have a recession. Do you think we'd go that low? And if we're already in a recession, isn't that a time where the market could already be bottoming, theoretically, because the Fed doesn't have to do as much?
Well, so think about the numbers here. Right now, we're about 23% down in the S&P from highs. Recessionary drawbacks are typically more than 30%. So if you get down to that 3,000 level that Mike is referencing, that's about a 37% drawdown from the highs. I think that we can get down into the range of 3,400 to 3,500, which would get us closer to 30% down in the S&P. And then that serves as support for a while until we know whether or not we're in a recession. But I think absolutely a 37% down in the S&P in a recessionary environment, that's pretty normal. And actually, that's pretty mild for a recession. So that's certainly a possibility going into the end of the year.